Topic 6 of the SCR program focuses on the measurement and management of climate risk within organizations and financial systems. The topic explains how climate change can create significant financial and operational risks through both physical and transition channels. It builds upon earlier discussions of climate risk by introducing methodologies, analytical tools, and governance practices used to assess and manage climate-related exposures. The program emphasizes that climate risk management is becoming an essential component of enterprise risk management frameworks because climate-related disruptions can affect corporate profitability, financial stability, operational resilience, and long-term economic sustainability across industries and geographic regions. The topic explains that climate risks can generate both microeconomic and macroeconomic effects. At the company level, climate events may damage infrastructure, disrupt supply chains, reduce productivity, or increase operational costs. At the macroeconomic level, climate change can influence inflation, employment, economic growth, financial market stability, and sovereign risk. The SCR program highlights that these effects are interconnected and can spread throughout financial systems and global economies. Candidates learn that understanding the transmission channels of climate risk is critical for assessing vulnerabilities and developing effective strategies that strengthen resilience at both organizational and systemic levels. A central theme of Topic 6 is the relationship between climate risk and traditional financial risk categories. The program explains how climate-related factors can influence operational risk, credit risk, liquidity risk, insurance underwriting risk, and market risk. For example, severe weather events may disrupt operations, while transition policies could reduce the value of carbon-intensive assets and weaken borrower credit quality. Climate-related uncertainty may also create liquidity pressures and market volatility. By integrating climate considerations into existing financial risk frameworks, organizations can better anticipate potential losses and improve strategic decision-making, capital allocation, and long-term financial resilience in uncertain environments. The SCR program also emphasizes that climate risk can become a source of systemic risk threatening overall financial stability. Climate-related disruptions may trigger cascading effects across sectors, markets, and economies through interconnected financial relationships and supply chains. Physical disasters, market dislocations, policy changes, or sudden shifts in investor sentiment can amplify systemic vulnerabilities. The program explains that financial institutions and regulators increasingly recognize climate change as a macro-financial risk requiring coordinated oversight and risk management approaches. Understanding systemic climate risk is therefore essential for protecting economic stability and maintaining the resilience of global financial systems under evolving environmental conditions. Another important focus of Topic 6 is climate risk metrics and measurement methodologies. Candidates study risk metrics associated with operational, credit, liquidity, and insurance risks while learning how climate-related variables influence financial outcomes. The program introduces Climate Value at Risk, CVAR, as a tool for estimating potential financial losses resulting from climate-related exposures. The topic explains how organizations use quantitative and qualitative indicators to assess both physical and transition risks at company and portfolio levels. Effective measurement practices help institutions identify vulnerabilities, prioritize mitigation efforts, improve disclosure quality, and support informed strategic planning in response to evolving climate conditions. The topic further explores the role of climate-related data and analytical tools in risk assessment. Organizations increasingly rely on climate models, emissions data, geospatial analysis, hazard maps, and scenario-based analytics to evaluate exposure to climate risks. The SCR program explains that different data sources are required to assess transition and physical risks effectively. Transition risk analysis may involve carbon intensity metrics, regulatory exposure, and technology adoption trends, while physical risk assessment often depends on weather projections and geographic vulnerability data. Candidates also learn about data limitations, inconsistencies, and challenges associated with modeling long-term climate uncertainties. Portfolio-level climate risk assessment is another major topic covered in Topic 6. Financial institutions increasingly evaluate the climate exposure of investment portfolios, lending activities, and insurance liabilities to manage concentration risks and align with sustainability objectives. The program explains methodologies for measuring transition and physical risks across portfolios, including carbon exposure analysis and scenario-based stress testing. Candidates learn how climate risk assessments support capital allocation decisions, investment strategy adjustments, and stakeholder reporting requirements. These portfolio management practices are becoming increasingly important as regulators, investors, and clients demand greater transparency regarding climate-related financial risks and sustainability performance. The topic concludes by emphasizing the importance of integrating climate risk into enterprise risk management (ERM) frameworks and organizational governance structures. Climate risk management requires coordination across departments, including finance, operations, strategy, compliance, and sustainability functions. The SCR program highlights that effective governance, risk evaluation processes, scenario analysis, and disclosure practices are essential for managing climate-related uncertainties. Organizations that proactively incorporate climate considerations into strategic planning and risk management are better positioned to improve resilience, satisfy stakeholder expectations, and navigate the transition toward a more sustainable global economy. Topic 6 therefore provides a critical framework for practical climate risk management implementation.